This is the risk graph of the buyer, which is us in this case. So whenever you deal in options, you're going to see risk graphs like these, and these are extremely important. For every options position, you have to plot your risk graph, and there are many other things also that you have to do, but this is one of the most important items. So the way risk graphs are laid out, on the x-axis you have the strike price or the price in general of the asset, whether it's a stock or a house, whatever it is. You can see it starts from 0 on the left hand side and goes all the way. Our $1 million price is this dotted line right here in the middle, and then perhaps it goes all the way up to $2 million. On the y-axis, you have the profit and loss. You have a zero line right here in the middle, and anything above the zero line is a profit, and anything below the zero line is a loss. So this graph actually represents our at-the-money option, which we bought at $1 million, and we paid $25,000 for it. So let's see how that works. So when we bought the at-the-money option, it is right here at the $1 million, and you can see we are instantly at a loss of an amount equal to the premium. So the premium is $25,000. So this premium, we are already below the zero line by an amount equal to this premium. So this is our starting point when we get into the option. If over the next 60 days, if the price of this option were to go above $1 million and 25,000, then anything above that is a profit. So you can see at 1,025,000, which might come somewhere here, you are hitting the break-even price. And anything above that is unlimited profit. You can see it continues to go up. On the flip side, if you look at it on the negative side, if the value goes all the way down to 0, it doesn't matter. Our loss is capped at 25,000. So you'll see an absolutely flat horizontal line which is parallel to the x-axis. So there is our loss, our maximum loss is 25,000. Regardless of what happens to the price of that house, our maximum loss is 25,000. It is capped. So that's how you look at profit and loss diagrams. You're going to see a lot more about this, not only in this course, but in every course, because every options position must be plotted on the risk graph. So let's now look at the risk profile of a seller. And not surprisingly, you can see that it is exactly the opposite of a buyer. And so the seller has unlimited losses as the price of the house continues to go up. So we saw at 1.1, 1.2, 1.3, the seller faces unlimited losses. And his maximum profit is $25,000. So this line here should be the $25,000 profit line. So he starts off with an instant profit of 25,000, but over the next 60 days, depending upon how the price of the house behaved, he would be able to capture a maximum profit of 25,000, or if the house ended up between 1 million and 1,025,000, he's still going to capture some profit. But anything above 1,025,000, you can see that the seller is going to face losses. So this is how you would look at risk graphs. This is how you would plot it. This is how you would need to study it. And then what we're going to do now is to look at the expiry and settlement obligations of both the buyer and the seller. So if there were a real market for this kind of an option in the real estate in the real estate space, then both the buyer and the seller, they would have to close out their positions by the expiry date, which was 60 days away. Closing out positions can be done by exercising. So if we wanted to exercise this option, we could do that. Or we could also exercise by cash. And this is specifically in the stock market. You could exercise for cash also. Any extrinsic value, so any time value that exists on the day of expiry will go down to 0. And I know that you've not studied time value and time decay, and that's coming up in the next course. But Any time value that remains on the day of expiry is going to go to zero because there's no more time left. And if the option is in the money, it will have its intrinsic value. So remember, intrinsic value is the true value that the option has today. So think about the $800,000 option, and that intrinsic value cannot be destroyed. Even on the day of expiry, it's going to have intrinsic value. So let's say we bought the $800,000 option, and 60 days later, the price of the house was exactly 1 million. In which case, we would have only lost 25,000 out of the 225,000, because the 25,000 was the time value. It was the extrinsic value, and extrinsic value will go down to zero on the day of expiry. However, it cannot destroy your intrinsic value. So intrinsic value always remains on the day of expiry. So buyer can always sell his option on the day of expiry and capture whatever intrinsic value remains in that option. If buyer wanted to exercise the option at the $1 million price, then the seller is obligated to sell. And both buyer and seller can close their positions anytime, even before expiry, in a real options market. So this is obviously, we are talking about the financial markets here, not a real estate market. So that's how we would look at expiry and settlement obligations. So just a quick wrap up on the call options. It's a summary. Call options give the buyer the right to buy and the seller has the obligation to sell. Buyer pays a premium, the profits are unlimited for the buyer and the losses are limited. But the stock must move in a bullish direction to make profit. So the stock must move higher because this is a call option. The seller receives the premium. His profit is limited to that amount of premium. His losses are unlimited if the stock continues to go up or if the value of the house continues to go up. From his perspective, from a financial standpoint, the stock can either remain flat or go bearish for him to profit on this option. Options are referred to as wasting assets, and they lose value every day due to time decay, and we're going to study time decay in detail. Time decay is a buyer's enemy and a seller's friend. So as far as the seller is concerned, time decay is on his side, and as far as the buyer is concerned, time decay is your enemy because you only have 60 days for this option to become profitable. In the money, out of the money, and at the money options have vastly different prices and they have vastly different probabilities of success. In the money options have intrinsic value and extrinsic value, whereas at the money options have only extrinsic or time value. So this concludes the theoretical part of this course. Now what we are going to do in the next part is we are going to go to the trading platform and we're going to look at Apple options. And I'll show you exactly what all we've studied so far. I'm going to show you exactly those things on the trading platform using Apple options.